So the topic of working capital is something that comes up often, and I always like to use the analogy of the gas tank. So I recently purchased a new car, and when we were negotiating back and forth the purchase price, I asked, about the features, how old the car was, and we went back and forth on price. But when I jumped into the car to do a test drive, I noticed the gas tank was about a third left. The dealer mentioned, he's been doing several test drives for the last couple weeks since it was a new car and there was a lot of interest in it. Um, and it made me think back to the days of, small business acquisitions and how this car, it needs gas. So when we were going back and forth on price, I said, I'd be happy to accept the sticker price, but can you fill up this gas tank in your shop so, I can drive home? I was about an hour 15 from home, so I didn't want to have to go to the gas station and put gas in the car in order to make it home. If I didn't noticed that, on the way home, I would have to head over to a gas station and take out my wallet and spend, 50, $60 in order to make it home. The gas tank analogy is similar in small business acquisitions. If you're a business buyer and you overlook working capital, that is the fuel or the gas to sustain business operations. So the reason why it's so important is if you don't get this number right, and if you're not delivered the correct amount of working capital at closing, you're responsible and you're going to have to take out your wallet or your personal, tap into some sort of cash in order to sustain these business operations. So if you were to reach for your wallet and you're running this small business, if you don't have enough cash to fill up the tank, I mean, you're in some serious trouble. You're not going to be able to go back to the dealer and ask for, a couple dollars in order to fill up the tank. They're going to tell you, this is your responsibility. These sort of sticky situations happen all the time, but at much greater scales than the car analogy. This 50, $60 could be 500 or $600,000 of liquid cash you need to sustain business operations for some, larger businesses. Um, so the working capital is important to understand how to calculate it, get this right. And very often when I'm looking at businesses with buyers, understanding how to calculate this correctly is mission critical to some of these small business acquisitions. So if you're under contract for a small business, representing sellers, looking for working capital target amounts, this webinar is going to be chock full. Um, if you are joining us on some of our other streaming platforms, feel free to put the messages in the comments and myself or someone from my team will flag them and we'll try to answer them, as quickly as we can. Um, with that, I like to get a lay of the land for business acquisitions and some of the folks joining us. So if you want to respond in the polling questions, it's always helpful to see who's here today and I can better tailor the narrative around that. So are you in your business search? Are you under LOI, actively searching? Or are you just starting out with your search? If I'll give about 10 more seconds to do that, and then we'll close the polling question. So it looks like about half of you are just starting your search, and then some are actively searching. So, why does working capital matter? It's really the cash to run on day one. When a deal can close with a strong purchase price, you still may be in a position where you're short on cash to make payroll in week one. For sellers, this protects the purchase price. A, a working capital true up, typically 60 to 90 days following closing, can leave, can risk hundreds of thousands of dollars at the closing table. Getting the peg correct before closing is mission critical for both buyers and sellers. For sellers, I always like to talk through the idea of a buy side team will likely try to peg working capital higher than the normalized amount. And the reason why they like to peg it higher is because if there's a shortfall in working capital, those often can be a dollar for dollar reduction of the escrow money held at closing. For example, if a buy side team comes in and pegs working capital at about $500,000, if when they're doing the true up, let's say 60 days from today, so if they were doing it in the June or July timeframe, if working capital um, was short, let's say it was 300,000, then what the peg was determined at, that $200,000 amount could be a dollar for dollar reduction. Um, Sellers lose right then and there, during the true up period. So if you're representing sellers, and you're joining us today, understanding how you can best protect the sellers is very important. If you're a buyer, you want to understand how the mechanics of working capital is structured in your deal to just ensure that there's liquidity post closing. If during the presentation you have, questions about some of the things I cover, feel free to just raise your hand or put a message in the chat, and I'll try to get to it as quickly as I can. So moving on, if we think about working capital, what's next? So if we want to go to the next slide. So let's meet Daniel. Here's a cautionary tale for those in the lower middle market. Daniel searched for a year and finally found his business, a commercial cleaning company, long tenure contracts, blue chip customers, EBITDA margins, which were strong based on the industry and were holding steady year over year. And there was a motivated seller nearing retirement. The seller reassured Daniel with words like working capital isn't a big deal. Um, I've never had an issue with cash. The business can sustain itself. Don't worry about it. We'll work it out. Daniel believed him, and he didn't push for working capital early in the discussions around the LOI. And, that's a decision where this story goes wrong. So, what did Daniel do? Next slide, please. So, what did the financials show? What Daniel saw was clean on the surface, revenue was stable, but what did he miss? He missed things like receivables were aging beyond um, typical customer terms. Monthly operating cash requirements started to trend upward, and the business needed more working capital than what was typical in the last few years. And vendors were demanding faster payment terms. So there was a little bit of a discrepancy. If you look on the right, customers were wanting to stretch terms, typically past the 30 or 45-day window, but vendors of the company, think expenses, they wanted to get paid sooner. So they wanted to get paid net 30, net 15, or pay, at delivery. So there's been a little bit of a change on how cash moves through the business. That's very important when you're thinking about working capital. So these are things that Daniel missed. So what happened next? The 250,000 bombshell. So discovered the week before closing, Daniel discovered a $250,000 deficit in working capital. What were the implications for that on day one? That meant that payroll wouldn't clear the first cycle. Vendors were pushing past due notices, and the lender was revisiting the terms because he wasn't sure the business could sustain operations. Daniel did close the deal, but he started from a hole. And it was due to this working capital deficit, primarily due to the change in terms. Again, think back to the prior slide. Daniel wanted the customers were stretching out terms of when they got paid, and vendors wanted to get paid sooner. And the owner, who had one foot out the door, wasn't pushing back. He wasn't pushing back to stick to the terms the business has been operating with normally, and this caused a serious issue. So what next? If you are searching for a business, want access to O'Connell Advisory Group's template, I created a 92-page toolkit I call the Business Buyers Toolkit. It is chock full of the financial due diligence process, working capital calculations, a management meeting agenda that we use on most of our deals, a financial due diligence data checklist. If you scan that QR code, you should receive a copy of this in your email today. If you want to flip back to this, feel free to reach out to us after the webinar, and we can also share with you a copy. So what's the definition of net working capital? When you're looking at a balance sheet, let's say you generated it from QuickBooks or another accounting system. Working capital is defined as current assets minus current liabilities. So what are typically included current assets? It's going to be things like accounts receivable, inventory, prepaid expenses. What are some current liabilities? For small businesses, it's typically going to be accounts payable and wages payable. Things like accrued expenses like wages, commissions, and then maybe some deferred revenue. Things that are typically excluded from current assets and current liabilities are things like cash and cash equivalents, so like the cash accounts of the business, and short-term debts. So if there's a short-term line of credit, any other short-term debt is expected to be excluded from working capital because typically most transactions are operated on a cash-free, debt-free basis. If you have questions around working capital and a cash-free, debt-free, I get asked this frequently, several times per week. This is just industry standard. If you think about how business transactions operate, at the time of closing, the old seller or the old owner of the business is going to keep the cash. They're going to use the cash in the company's bank account, and you'll be left with the accounts receivable less some current liabilities such as salaries and wages payable and some accounts payable. Everything else, things like related party balances, et cetera, is going to be excluded from working capital. So if you don't remember anything from this, keep in mind for small business acquisitions, what I typically see is the material balances of working capital are going to be comprised in accounts receivable and accounts payable. Um, if you're a buyer, what you should be concerned about is what is the accounts receivable at the time of closing? Because that's going to be the typically the largest balance that is delivered to you in the form of working capital at the time of closing. So let's walk through a simple working capital example. Let's take a look at the coffee shop example, one snapshot at a time. So let's say the coffee shop has 160,000 of current assets, 65,000 of current liabilities in the form of accounts payable, such as like invoices from suppliers, payroll, accrued wages, um, and some taxes payable. In current assets, it's going to have things like cash and cash equivalents, inventory, receivables, and prepaid expenses, things like rent, insurances, and leases. Um, if we flip back to our example, the reported working capital is current assets less current liabilities. Um, so looking at this example, it's going to be 160,000 minus 65,000 equals the working capital number of um, 95,000. The question I get asked all the time is you mentioned it should be cash free, debt free. So when you're presenting a working capital peg, which is the target working capital number, you want to remove the cash from the bank because the seller is going to keep the cash at the time of closing. So in reality, working capital is about 35,000. So if based on this calculation, one snapshot in time to me dictates one point of time or 1 month. When you're looking at working capital, you want to assess averages. Averages over the period of 12 to 24 or 36 months. This example is very simple to understand the mechanics and the formulas behind it, but I just wanted to call that out. So what's next? So three common misconceptions that sink deals in working capital analysis. Here's what I hear from both buyers and sellers. And this is you, feel free to raise your hand and we can talk about it. What buyers uh, often assume is, why isn't the cash in the bank included at closing? Uh, when you take, if hypothetically you were to take ownership of cash, liquid cash of the company's accounts, those have significant tax implications. Typically, deals are a cash-free, debt-free basis. Um, if you're going to assume, the rights around cash at the time of closing, you're also going to have to assume some of the debts. So my recommendation, and this is not legal advice, is to operate under the assumption that the deal is going to be structured as a cash-free, debt-free basis. It's typically much cleaner, so I always recommend it. What sellers often assume is working capital is whatever the business needs for the next month or two. I also hear things like, I don't want to deliver working capital. You don't have a right to the accounts receivable at the time of closing because I already paid for my employees and my labor costs to produce this revenue or these sales for this customer. So why should I give you the right to this at the time of closing? The challenges with both these scenarios is one, if you're a buyer pursuing, a small business deal, I would expect and get ahead of some of these conversations early. Very often, sellers don't understand the idea around working capital. They think that buyers should bring their own working capital. They should not have a right to the accounts receivable for completed sales, um, so on and so forth. There is no one correct answer. My recommendation is to get ahead of these conversations and talk to the sellers early in the process to get an understanding of what they both, what they feel is fair and reasonable and what you feel is fair and reasonable. How I see deals blow up is both sides thinking one way or another and not having a conversation around it until very close to closing. Um, it's very easy to punt on this discussion because it could be an awkward conversation. But these are typically, I've seen accounts receivable balances which are in the millions of dollars at the time of closing for a sub $10 million deal. So this can be 10, 20, 30% of the total transaction price sitting in accounts receivable. So whether this is included or excluded at the time of closing is significantly material. And this is why a lot of these deals do break because of this topic. So keep that in mind, have these conversations early, and this can better salvage your deal. So what are three ways to calculate working capital? We walked through the simple example. And I'll push back on the textbook version because the definitional working capital, in my opinion, is the cash-free, debt-free. So it's really this narrow method. Um, the narrow method is current assets minus current liabilities reduced by cash and debt. So if you were to pick one of these, I would go with the narrow method. The specific, and I see this occasionally, but not as much now. If you were going to um, purchase certain items from the balance sheet, this would only work in the case of an asset sale, or in an asset sale, you could select and purchase certain things from the company's balance sheet. So you could buy the inventory, you could purchase the accounts receivable. That's the specific method. Um, I don't see that as often. So if you're going to go with that route, you want to understand the composition of inventory and AR as well as accounts payable to make sure you get this number right. But here are three ways to kind of, calculate working capital. So let's walk through three examples and why the peg or the working capital peg can vary drastically based on industry, balance sheet dynamics, and what to do about it. So let's start on the right with the construction example. The construction example, construction businesses in general have significantly higher accounts receivable. You'll see if we zoom in, accounts receivable was $2.8 million on a $10 million revenue business. 2.8 million is roughly 28% of total revenue. That is significant. The reason why AR builds up in construction businesses is because Customers have typically much longer pay cycles. Could be 60, 90. It's actually typically 90, 120 days until payment on the low end. Um, a lot of these accounts receivable are held in deferred revenue. You'll see a little bit of deferred revenue in this example. Um, so when you're calculating working capital and when you're trying to when you're trying to peg or place an appropriate level, you got to keep in mind the industry. For construction, I would err on the side of a higher working capital amount based on how the business is trending over time. Um, you'll see that AR and AP are pretty significant in construction. They they receive collections from customers pretty short, pretty long, and then they pay vendors quickly. Consumer products, I would say it's typically a moderate level. You'll see that AR was roughly 900K or 9% of the $10 million revenue business. If we walk through the example, AR and inventory are the bulk of the current assets, just over 2 million. And the AP and deferred revenue were roughly 1.5 million. So the narrow definition has about 600K of working capital or 8.5% of sales. On the flip side, in a software type business, there may be a situation where there's negative working capital. And that's because deferred revenue from subscriptions delivers cash before the work is done. In the cases of negative working capital, if it's not able to be delivered at the time of closing, it's not going to be applicable to your deal. So I don't see working capital negotiated in software deals, just given the dynamics of the company. With that being said, you want to understand the cash needs of the business and make sure that you're able to tap into a cash source at the change of ownership. If you want to take a screenshot of this, this is a typical due diligence timeline for a business buyer under contract. So you'll see that there's a signed LOI. Between days 1 and 30, you're supposed to kick off financial diligence. Um, if you want to take a snippet and save this to your desktop, I use this for typical LOI terms for our buyer clients. So when does working capital show up in your deal? Um, if you're still with me, pay close attention to this because working capital, when you should have these discussions and when it actually matters, is very important. So the working capital peg or the peg isn't a single point of time. It should be based on the analysis of the company over a historical period, typically anywhere from uh, the trailing last 12 months, the 24 months, or the last 36 months of the business. So when you're even having these preliminary discussions, call it the pre-sale, you want to be analyzing the historical balance sheets of the company. You may be limited on what information you're granted before you do submit this LOI, but typically you can look at stub periods. So for example, you could look at what AR was, as of 12/31/25, 24, and 23, just to get a sense for how is AR changing year over year with the company, and you can compare that with revenues and profitability. Is revenue and accounts receivable correlated? So let's say hypothetically revenue is increasing, is AR following the same trend or is it changing? You could take a look for the same thing for expenses. Is accounts payable increasing in line with expenses or are they deviating? For both parties, at the time of the purchase agreement is really where you're going to lock in this working capital peg and set the terms for a true up if it's applicable. So if you're doing a construction or some of those other heavy working capital businesses, pay close attention and make sure this is getting included in the purchase agreement. Um, the financial due diligence team at OAG spends a lot of time working with buyer and seller counsel to make sure working capital is defined correctly, um, and can be used for the framework for this true up period. So we're typically engaged on a limited basis, whether or not we've done the sell-side QOV to at the time of purchase agreement to make sure working capital is defined correctly, because this is a dollar for dollar potential reduction for sellers, and can really set the stage. Following closing, you know, typically you finalize working capital and you use this defined true up period to recalculate working capital and you compare it for the amounts at the time of closing. And that's where the dollar for dollar reduction can be applicable. So typically, working capital is discussed throughout the deal, but doing this analysis upfront, double checking your work at the time of the purchase agreement and closing, and then conducting this post-close true up is really this 3 to 5 stage process of how working capital translates to your deal. So I always say the earlier in the timeline you engage working capital, the fewer surprises you have at the time of closing, purchase agreement, and during the true up period. Um, a cautionary tale for folks who may overlook this, we are often engaged with working capital disputes during the true up period. So for a hypothetical example, we've been engaged dozens of times for working capital disputes when the buyer and seller didn't have proper representation, and it was really just handled by attorneys. And we are tasked to recalculate working capital at the time of closing compared to true up because the buyer is demanding a dollar for dollar reduction in the sale price or the escrow amount. Um, so if you're representing sellers and you think you're comfortable with this, I would often engage a CPA firm specializing in transactions, like my group or someone else, because this is where sellers can really be taken advantage of, and or buyers can be in a position where they have a cash crunch because they didn't calculate this correctly. So what are some of the key takeaways? Here's a 4-step framework, and how smart buyers avoid the trap. We're not going to go through all this in detail as we run up on time because I do want to leave some time for questions. But the 4-step framework is really to analyze the trends and seasonality of working capital. So number 2, you want to review the last 12, 24, and 36 months of operating assets and liabilities. Pay close attention to aging receivables and growing payables and seasonal peaks and low points because patterns of working capital matter more than, the historical averages because small businesses change significantly from year to year. Often when buyers get in trouble, when it comes to working capital is when they um, expect accounts receivable to include collectible and current receivables, um, when in reality, there may be significant receivables which are uncollectible still sitting in accounts receivable. So let's think back to the construction example. There was 1.8 million of accounts receivable sitting on the books at the time of closing. What are you going to use those receivables for? You're going to use those receivables to pay salaries and sustain business operations. But what if those receivables you actually can't collect? What if those are, receivables from customers who have gone bankrupt or customers who refuse to pay you because they believe work was incomplete, and you've actually been trying to seek a claim against them in court? Those receivables are not guaranteed and very likely will never be collected by the business. So why should you as a buyer be reasonable to think you are going to use those for future business operations? The answer is you shouldn't. So you want to dissect receivables, the AR balance, as well as the accounts payable balance to make sure there's no um, uncollectible situations or changes in the business. And then from there, you want to calculate a normalized working capital peg, which is step three, and then lock in this peg in the purchase price um, to develop a mechanism for that true up period following closing. So if we go to the closing adjustment, let's walk through a simple example of what does the closing adjustment look like. So if we want to head on over to that one, so the closing net working capital minus the pegged net working capital is this purchase price adjustment. So if the closing net working capital on the right is short of the peg, the buyer gets a price credit. In reality, if we go to the example, let's say working capital was pegged at $1.14 million. At the time of the true up, the working capital was short, so it was under the $1 million mark. This dollar for dollar reduction would be removed from the escrow amount from the seller. So right there, the seller is uh, short 250,000 because there was a shortfall in working capital. On the flip side, if an escrow is agreed upon and the closing net working capital amount, which is at the time of the calculation, is greater than the peg, this may warrant a price increase within the escrow amount. So again, this closing adjustment escrow analysis is a dollar for dollar impact. So it's very important this is included in heavy working capital businesses. And if it is, working with the proper deal team to make sure you get this right. So what are some of the key takeaways in closing? I always like to think there's 7 key takeaways to carry into your next deal. Working capital is the gas tank for the business. It's the fuel the business needs to run on day one. EBITDA drives valuation. Working capital and getting the working capital peg correct keeps the lights on and the car moving. You want to analyze 12 to 24 months of assets and operating assets and liabilities. Trends matter more than a single snapshot in time. When you're looking at the working capital needs of the business, you want to assess it on a analysis period, typically of 12 to 36 months. Um, but when you're selecting the peg, you want to understand what is the business industry I'm working in? How is the business performing? Is the business changing as we inch towards closing? And what is an appropriate level of working capital to sustain the current business I'm walking into? Pay close attention to sellers who may not be as close to the numbers and may try to encourage a lower working capital amount or a back of the napkin amount, a back of the napkin calculation when it comes to working capital. I would strictly focus on the balance sheet performance and the collectability of accounts receivable and accounts payable and some of those material balances when it comes to working capital. Um, Once you set the stage and the lay of the land for how working capital is going to be calculated, bake that into the purchase agreement. Define the methodology and engage that CPA firm and working with your M&A counsel to clearly define this methodology is best practice. Um, Typically, what sets the stage for success at the time of closing is a clearly defined methodology for how working capital is going to be calculated at the time of closing, and then how it's going to be calculated during the true-up period. And then from there, it's a simple math formula. Where I see disputes in litigation is when there's not a defined methodology for working capital. Um, so best practice and what we tell all of our clients at OAG is defining your methodology for working capital and establishing this in writing within the purchase agreement is best practice.